Good evening, everyone. Welcome to PayTM Wealth Community session on importance of PMS, active fund management. I am Nisar Golesh, and I'll be the co-host for this exciting session. First of all, thank you for joining us on this Tuesday evening to learn and invest in yourself. The simple fact that you are here tells me that you are eager to learn more about PMS. Guys who are watching on Zoom, please raise your hand so that I can unmute you and you can ask your questions. People who are watching on PayTM Wealth Community or on our YouTube channel, please feel free to write your questions on chat and I'll be happy to take them. Just a last thing to get out of our way quickly. Here are the disclaimers for the event. Investments in the securities market are subject to market risk. Read all the related documents carefully before investing. Representations are not indicative of future results. All the discussions are purely educational in nature and are in no way an advice or recommendation. Well, now that is done, we can start with the learning. Let us all welcome the host for the event, Mr. Varun Sridhar, Director and CEO at PayTM Money. Varun has more than 2 decades of experience in financial services industry. Hey, welcome, Varun.
Hi, Nishar, and good evening, everyone. Good evening to our users, my customers, and the reason why we exist. Pleasure to see all of you, and it's good to see you. I'm back in a live event after some time, so very good to see you, and I'm very happy I'm doing this today with Aashish. I think fantastic guy. I told my team that I want to host this session because I think it's super exciting and something very nice is on your way. So yeah, but thank you, Nishar.
Agree. I would now like to call Mr. Aashish Somaiyaa, CEO at WhiteOak Capital Management. He has more than 2 decades of experience in the industry and is solely responsible for strategizing, growing, and managing operations at WhiteOak Capital Management, a highly differentiated equity boutique firm managing offshore funds investing into India with a total of 3.8 billion worth of assets under management. Welcome, Aashish.
Thank you very much, Nisar, and thank you, Varun, for having me here. Thank you for inviting me.
Sure. So over to you, Varun. I'll be around if needed.
Absolutely. Okay. So hey, good evening, everyone. Pleasure. And Aashish, welcome to PayTM Money. Welcome, to PMS Bazaar. Very happy. And I'll tell you why I'm happy, and I'll tell you why I'm excited. Okay. Last 2 years, I accumulated some capital. And I have invested personally. Okay, so I've been trying to manage my own investing account till one day I was, and with all honesty, I was not really aware of what is PMS, right? So I knew that there is something called PMS. मुझे पता था कि PMS है, अच्छी चीज है, but I used to always feel, यार this is maybe either too simple for me or too complex for me. Like I never felt this is something that I could seriously consider or look at. And then, I started reading one day and one day led to the other and so on and so forth. And I met Pallav, who's the founder of PMS Bazaar. And, together we've set up this beautiful platform on PayTM Money where we have, I think for the first time ever in India, all the PMS is listed together, right? And you can transparently see what a PMS means. And I can tell you in the last 1 year, I'm completely hooked, right? And I'm completely curious and intrigued, and I'm an actual investor, right? So I have started my journey. And I think while I was doing that, I met a lot of other HNI, right? I met a lot of other people because SEBI says 50 lakh se upar, right? And, as you all know, if you have 50 lakhs, you can take a PMS product. And I think, but if you're an accredited investor, you can come in slightly lower and, maybe we talk about that. But when I was asked to host you, I think I was very happy for 3 reasons. One, I think the kind of products you're managing are fantastic. I think the professionalism with which you're managing, because I've noticed in India, PMS can be construed as not being so professional. But I think, the professionalism that you bought in, which is, I think, A grade, top notch, as good as the best bank or asset management company in India. And I think the fact is, because you bring the professionalism, it's fantastic. Second, I've seen your returns. I don't want to say much. You will speak about them. I think the returns are fantastic, given the risks and given where you stand. And I think third reason, what I really liked is the openness. I think you're embracing the new India.
Absolutely.
Right? And I'll start off with my Aashish. My first question to you Many users are going to wonder, why PMS for me? Why should I even spend the next 60 minutes listening to Varun asking questions and Aashish answering? Why ye PMS hota kyun hai? Why is it so important in my life? But Aashish, over to you, and very happy again to host you.
Thank you very much. So should I run the presentation first and then?
Yes, please. Yes, please, as you like. And we'll run a presentation, everyone, which Aashish will run, and he's going to walk you through a bunch of topics. And I'll keep, switching off my camera and keep coming back to ask Aashish some very tough questions. If you have questions, fire away in the chat or in Q&A.
So Varun, on your, thank you very much for giving me the opportunity to come here and speak to the esteemed audience. I think opening with Varun's question, that is what the whole presentation and today's session is about. That why should you even bother with a portfolio management service? So what I'm going to do is that I'm going to cover two parts in the presentation, like the title says, investing in PMS, and it specifically highlights related to active management. So I have a presentation out here, which broadly speaking has maybe about 16, 17 slides, but broadly speaking 3 parts. The first part is just a couple of slides to acquaint you with the data in terms of what do globally people do when it comes to engaging with the asset management industry. Mutual funds, alternate funds, PMS. So what is the global trend? What exactly are people doing in terms of their investments? The second part is, often on media, on social media, and nowadays there's a lot of discourse and a lot of talk about active management versus passive management, because that's also part of our topic as to how to use PMS in an active management framework. So a little bit about active and passive. I think a lot of our investment knowledge is derived from the Western world, and more specifically from the US. So I'm going to share some data with you in terms of how the market is behaving in US versus how it is in India. And when it comes to this active versus passive debate, where are we in India? And then the third part, of course, is directly diving into our presentation as to why PMS is relevant, or how PMS is different from, say, mutual funds, or even sometimes you must be hearing about alternate investment funds. So why is PMS nowadays a preferred choice or a preferred vehicle? And right up front, Varun asked me that why should people spend some time listening to us? Let me serve up, one piece of data for your attention, which I'm very, very sure is going to come as a surprise. If you take the last 10 years, I'm sure most of you are engaged with PayTM Money because of the mutual fund offerings. And here you are today trying to learn a bit about PMS also, which is adjacent. But just to give you a simple piece of data, in the last 10 years, equity mutual funds total assets in our country, 10 years back, total value of all equity mutual funds was 1.5 to 1.6 lakh crores. Today, that value stands in the range of 17 to 18 lakh crores, the total value of all equity mutual funds. So what does that tell you? It is approximately 10x in the last 10 years, right? But do you know what has happened as far as portfolio management services are concerned? 10 years back, the total value of all portfolio management services was less than 10,000 crores in terms of assets. And today, as we speak, it is somewhere in the vicinity of about 3 lakh crores. I'm talking about discretionary equity portfolio management services. So while the equity mutual fund industry has gone 10x in the same time frame, the equity PMS industry has gone literally 30x. Now, needless to say, 10x and 30x look like large numbers, but one must also keep in mind that 10,000 crore is, like on a low base. So on a low base of 10,000 crore, when it becomes nearly 3 lakh crore, it looks 30x. But even though it is starting from a low base, you will appreciate that if you take in percentage terms, so let's say 10 years back, 1.5 lakh crores equity mutual fund and 10,000 crore equity PMS. So let's say the managed equity industry was total of 1.6 lakh crores. That 1.6 lakh crores has gone to about 20 lakh crores. So PMS, which was say 10,000 out of 1.6 lakh, has gone to being 3 lakh out of 20 lakh. So you can see that incrementally, if you look at the pie expanding, you can clearly see that incrementally a lot more of the pie has found favor of investors going into PMS. So broadly speaking, what has caused this change and where are we in the industry's evolution? I have some slides to share with you today, and let me just pull up my presentation.
While you're sharing, Aashish, we got a question from one customer. I'm not taking name because of sensitivity.
Sure.
Of investor. They say, hey, why, and maybe you can cover this during your presentation.
Sure.
They say, why is WhiteOak PMS having as many as 60 stocks, and why do you turn frequently? And how does that make you different, and what's your strategy? I think this is a question that anyway you would pick up in your investing style, strategy, and so on. But I think it's a good question that we got, so I thought I should put it to you.
Sure. Thank you, Varun. So actually, frankly, my intention was not so much to cover about WhiteOak products so much as opposed to educating on the category. But since there is a specific question, I will definitely address it maybe at the fag end when we get into the discussions. Now, this is what I promised to share upfront, that where do people, how is globally the asset management industry actually moving vis-a-vis active management versus passive management, and vis-a-vis the whole PMS business. So if you actually see, this is the source of this is BCG, which is widely regarded for their research and consulting efforts as far as the asset management industry globally is concerned. This is public data. The report is available on the internet. So what does this show? It says global assets split by product. And you can see that it has 5 strata. These are bar graphs. The fourth one from the left tells you the data as of 2020. And the way to read it is that the dark green at the bottom is passive products. The next one is equity mutual funds, what is called as core active products. Then you have solutions, like nowadays in our industry, we have balanced advantage funds, multi-asset funds, etc. So that is solutions products. Then we have this lime green color out here, which says active specialty. So on a global scale, small cap products, global emerging markets, a lot of these specialty products, which are not just general large cap, diversified, multi-cap kind of funds, that all comes as specialty active. And the yellow one is what we call alternatives. So which means that managed accounts like PMS, alternate investment funds, a lot of that would show up in these. Correct? What does this data actually tell you? While if you really see, there is a lot of media and social media related discussion about passive versus active. I personally find that discussion to be a bit futile. The reason being that it's a no-brainer. If active managers, whether it's a PMS or a mutual fund or whatever it may be, if active managers do not generate alpha, it's obvious that the money will go to the passives. That's actually not a very, very big debate. It's quite obvious. But what is interesting is that while there is so much of debate or discussion on the movement of active money to passive, the trend which gets missed out first is that on an absolute asset basis, it's not like active equity funds are declining. If you see in 2009, active equity funds had 18 trillion in terms of assets under management. In 2019, that 18 trillion became 29 trillion. In 2020, it became 32 trillion. And it is projected by 2025, it will be 36 trillion. So while if you take the whole pie, passives are taking a bigger part of the pie and active equity mutual funds are taking lesser part of the pie, the truth remains that active equity funds are still growing. That's one thing to be highlighted. The second thing to be highlighted out here is that while there is a lot of awareness and discussion about movement from active to passive, the bigger trend actually is that assets are moving from active or active, the bigger part of the pie is actually going to solution-based products. It is going to specialty active, meaning on a global scale, global emerging markets, small cap funds, thematic funds, tech funds, and to alternatives. So your alternate investment funds, discretionary products, all of those managed accounts would all fit into the alternates. So what I've highlighted red out here is something to keep in mind for anybody who is tracking this industry or is interested in this industry. While there is lot of screen time and lot of media time going into the active versus passive debate, the equally important or probably bigger trend in terms of share of pie is that money is also moving while active is not losing on a AUM basis or in dollar value basis. The equally big move, active to passive is not the only move. Active to solutions and specialty active and to alternates in aggregate is a bigger trend. So this is something which one must keep in mind. Second, in the last few years, you may have heard that will active funds in India. Before we come to PMS versus mutual fund, etc., I'm tackling this active part first. Would actually active funds in India continue to deliver outperformance? And of course, that's a matter of discussion because in the last 2-3 years, specifically 2018 mid till mid 2020, active funds actually struggled to outperform. The reality is that while there have been regulatory changes and the operating latitude of active funds has been reduced, what we should keep in mind is we worry about indices capturing markets before markets capture the economy. So, India is a country where the first insurance company, first diagnostics company, asset management companies, bulk of our economy or a good or a sizable part of our economy is not even listed. That's why I've written here that do not worry about indices capturing the markets before the market itself captures the economy. For sake of example, in many countries in the Western world, insurance is as big or a bigger sector in the indices as compared to banks. We are living in a country where the first insurance company got listed 3-4 years back, and they've barely entered our index. To add to it, institutionalization is nascent, private markets are in early evolution, and also keep in mind, for instance, we have financials as the biggest sector in our industry, in our market. The fact is that in most parts of the world, it is IT, tech, and internet, which have actually become the larger part. So a lot of our impression that we will not be able to generate alpha comes from the US. So next couple of slides I'm going to share with you that have we really become US? What is the difference between US market construct versus India, and why we should not start assuming that India has actually become a US, and why we should not start assuming that just because in the US there is dearth of alpha, the same thing applies to India as well. This is something which I pointed out in the previous slide, slightly busy one, so let me just quickly explain it to you. You're just looking, please focus only on the dark blue and the red. The dark blue bars represent the weightage of a particular sector in S&P 500 index, and the red bars represent the weightage of a particular sector in our own Nifty 500. What you will find is that in the US, for instance, financials are 11% of the benchmark, and in India, 24% of the benchmark. And then look at IT. In the US, S&P 500, 27% of the benchmark is technology, new age technology, not even traditional technology. It's 27%. In India, it is only 14%. And in India, by the way, there is nothing called new age technology in our indices. It's only ITES, which is in our indices. So what you will find is that we are in a very, very different spot in terms of our market cap evolution versus what we see in the US. The other important point is that, for example, in India, we know that large part of the market is owned by promoters, government, and retail investors. Whereas in the US, you can clearly see that large part of the market has moved in favor of institutional ownership, and individual ownership is consistently declining. The other important thing is it's not just institutionalization with movement to alternatives. So a lot of companies are being now owned in the US, for instance. I think a more interesting data point will be to see this. Just see what has happened in the US in the last 25 years. The number of listed companies has actually halved. So between 1996 to 2019, the number of listed companies has halved, whereas the market cap has gone up literally 3x. And by the way, This doesn't include the froth of 2020, 2021. This data cut is only as of end of 2019. So in the 25-year period between 96 to 2019 in the US, the number of listed companies halved, whereas the market cap actually tripled. So what does that tell you about the ability, or what does that tell you about the playground? What does that tell you about the play field? The fact is that the number of listed companies that are available for fund managers to play in, you can see here there is a consistent decline in the number of micro cap and small cap companies in the US, and there is a consistent rise in the number of buyout funds, SPACs, and private vehicles. So what is happening is that in the US there are 2 or 3 trends. Institutionalization is big. Ownership in private markets is much bigger now, or getting to be bigger compared to public markets. What do mutual funds do? They buy listed public companies. But if the number of companies available in the listed market keeps declining, even as they become more and more large cap, as the market caps keep going up, but the number of companies decline, obviously it cuts short the operating space for the listed equity managers to generate alpha. In a way, I can say that alpha in the US has migrated from public markets to the private markets. Now, do you really think that is something what is happening in India? Where are we in India in terms of institutionalization? Where are we? Okay, whatever institutions we have in India, what is their asset allocation? It's largely fixed income. What is happening to the number of stocks and the investment universe in India? Exactly opposite of the US. The number of listed companies in India by now is higher than US. We have more number of listed companies than even the US, and they are rising day by day. Where are we on private markets evolution? In US, private equity culture is more than 40 years old. In India, it's barely 10 to 15 years old. And at what stage do companies come to the market? In the US, few years back, companies used to get listed within the first 7 or 8 years of their existence. Today, they are coming to the market anywhere between 15 to 16 years or 12 to 16 years of their existence. And where are we in India? In India, companies are, all these companies which are getting listed, they have been in the private domain for 10, 15 years, and then they are actually coming to the market. So these are few things we should keep in mind. I would just, on the first part of my presentation, I would just urge you to keep in mind that India is not becoming US. In fact, every time the economic conditions, every time the economic growth narrows, active fund managers have found it difficult to beat the benchmark, because when economic growth narrows, obviously corporate performance narrows, and that gets reflected in the markets and the indices. So just because a couple of years we have had underperformance, partly also regulatory changes, but just because a couple of years we've got underperformance, don't start assuming that India has become US. I've shown you enough data to tell you why the US market construct is very, very different from us, because of institutionalization and because of private markets being very, very big. Coming to where we are in India in terms of PMSs and alternate funds and the like, this is something I already told you about, that in the last few years, I have longer data. In the last 10 years, PMS industry has gone from literally below 10,000 crores to close to 3 lakh crores. If you see this data itself, which is only 5 years, from 2015 till end 2021 itself, we went from 50,000 to 2.5 lakh. So huge growth as far as discretionary portfolios are concerned. A close proxy or a close similarity with discretionary portfolios is also in alternate funds. You can clearly see that has also been rising. So India is clearly following global patterns, if not in the alpha domain, but at least in terms of the rise of alternatives, which I showed you as the breakup. What is the reason for it to be further accentuated? First is, of course, reach and availability. As reach and availability rises, digitization, our friends at PayTM Money, they are obviously taking this initiative to spread awareness. So as reach and availability rises, you will find that there will be more growth in the PMS space. Ease of operational aspects and onboarding, that's obviously the benefit of digitization, which our friends at PayTM Money and PMS Bazaar are also enabling the industry to do. Innovation in terms of different types of products. Other asset classes coming into alternates like PMSs and AIFs. Clearly, there is a growth in the HNI base. I think that's another driver of growth for this industry. And the last one to keep in mind is that as mutual funds, I think 10 years back, the number of unique investors in mutual funds were barely 6 to 7 million. Today, they are approximately 31 million or 3.1 crores. So clearly, as the mutual funds become more and more mass and more retail and more widely available or ubiquitous, there will be efforts to make it more streamlined, make it more standardized and easy to understand. And standardization often results in straitjacketing, right? And as a result of that, people who want different risk return combinations, people who want a bit more enterprising approach to investing, they will clearly start migrating towards the PMS kind of vehicles. In fact, in the recent past, even for plain vanilla equity exposure, we are finding that there is increased preference for PMS. Reasons are simple because mutual funds are going through standardization, like I said, which also sometimes results in straitjacketing. So mutual funds have a pre-dictated investment universe. That what is large cap, what is mid cap. Mid cap funds can only invest in 150 stocks, predominantly 65% of their portfolio. What is large cap, again pre-dictated. Specified stock exposure limits, inflexible expense structures. Plus, of course, in a mutual fund, you cannot have all these performance-linked pricing, etc. So clearly, PMSs offer a lot more investment latitude and a lot more commercial latitude as well. The other thing, it's not like there is no regulatory development in PMS. Even for PMS, disclosures, expense ratios, a lot of those things have standardized. So compared to 10 years back, when PMS was perceived to be loosely regulated or not so well regulated, from that point onward till now, while mutual funds have got very much more regulated, it's not like PMS industry is untouched. So while mutual funds become more straitjacketed, PMSs still enjoy fair amount of investment latitude and commercial latitude, but it's not like the transparency, the reporting, and some of the best practices, they all have got aligned. But most importantly, PMSs are proving to be a preferred platform because of unfettered investment mandates, which often results in superior performance potential. I'm sure our friends at PMS Bazaar and PayTM Money have made a lot of data available to you, which you will be able to compare and understand how PMSs are doing amongst each other as well as across PMSs and mutual funds. So investment latitude, commercial latitude, and many of those. One of the most common objection that I have found in talking about PMSs is that people have this perception that it's not very transparent. Let me tell you, there is nothing farther from the truth than this particular perception. The reason is because when it comes to a PMS, every client has a bilateral agreement with the portfolio manager. And as far as PMSs are concerned, our regulations are right up there. The regulation demands that practically every month a debit note for expenses is shared with clients. All buy and sell trades are shared with clients. Each and every transaction. So for example, if you invest in a mutual fund doesn't tell you what stock was bought at what price and when it was sold because it's managed as a large pool. Whereas in a PMS, every account is segregated. So what is the expense incurred specific to your account? For example, in a mutual fund, you just get one NAV and that NAV is net of expenses. Whereas in a PMS, what is the expense incurred for the management of that specific account? What stocks are bought? At what price? What brokerage is paid? What FTT is paid? Everything is transparently reported automatically. It's not like you need to ask for it. In fact, the regulator has standards whereby at the end of every month, this data has to be provided to every client. Obviously, your portfolio is in your demat account, which is segregated for you. You have your own login and you have the viewing rights for the portfolio at any point in time. Most PMS managers provide live portfolios with a 3-day, 7-day lag. We ourselves update it with a 15-day lag to ensure there are no impact costs. So if somebody thinks that PMSs are not transparent, I would seriously contest that. And now our friends at PMS Bazaar are obviously taking transparency to another level, because in the past, this transparency was available to the subscriber because it's a bilateral agreement. But now there is industry level reporting. So even if you're not an investor, if you're just an outsider or a spectator, even for you, that data is easily and widely available. There are a few other benefits of a PMS which come out very clearly because of structural differences. In the previous slide, I was talking about regulatory changes, but here I'm talking about structural differences. What's the difference between a PMS and a mutual fund? See, the first is that a mutual fund is a pooled vehicle, whereas in a PMS, we manage individual clients' portfolios. While those portfolios may have a model portfolio approach, and for the same mandate, the portfolio will be the same. But the fact is that in a mutual fund, the mutual fund is managed as one gigantic pool for millions of customers. Whereas in a PMS, portfolios are managed commonly, but held by segregation in individual demat accounts. You might think, so what? But I think there is something which isn't obvious from what I'm saying. Let me explain that further. In a mutual fund, what would happen is that if, let us say, an exaggerated circumstance like March 2020, right? I don't know how many of you track this data, but in March 2020, the mutual fund industry had a redemption of 34,000 crores. While net, we also had inflows, but never confuse inflows with outflows, because the funds which get inflows are not necessarily the funds which also got redemption. So the fact is that there was 34,000 crores of redemption. And in March 2020, if you get 34,000 crores of redemption, you have to pay the redemption proceeds. So what happens is, in a mutual fund, there are many decisions on any given day. There are multitude of decisions that a fund manager has to take, not because he has a view on any stock, but he has to take those decisions of buying or selling purely in response to the fact that some people have chosen to give him additional money and some people have chosen to call their money back. Now, if you take the 15-20 days, from say 8th, 9th March till 31st March, or say 7th or 8th of April in 2020, and if you have to pay for say 30,000 crores of redemption, how do you pay those redemptions? You obviously sell something. And what do you sell? You will sell what's sellable, because in March 2020, you could have sold stock of the largest bank, but you could not have sold stock of a mid-cap bank. So if you have to pay redemption, what will you sell? You will sell what is sellable. But if it were to be a PMS, let us say that Varun is a very, very smart investor, and he and me both are subscribers to the same PMS. Varun is a very smart investor. In March 2020, he has his entire psychology and behavior under control, and bang on 23rd March, he wants to invest. But I am not in the same league. And on 23rd March, when Varun is rubbing his hands in glee, I am actually getting sleepless nights. So just when he decides to buy, I decide to redeem. So how will a PMS process this? A PMS will process it by selling my demat balance and paying to me, and using Varun's funds to buy stocks for him to credit in his demat account. So that's the difference. I've just written one sentence, pooled vehicle versus segregated portfolios, but you must focus on the third point out here. What does it say? It says isolating flow behavior. All of us, we read a zillion times that one of the key, or the sole or the key determinant of outcomes for an investor is their behavior or their psychology. So if you're in a pooled vehicle versus a segregated portfolio, what's the main difference? My behavior or my psychology is isolated from Varun's behavior or his psychology. And there is no net, we are not acting on a net effect of people either buying or selling. I can come here and say whatever I like, but the day I get inflows, I am a buyer in a pooled vehicle. And the day I get outflows, I am a seller in a pooled vehicle. But if it is a segregated portfolio, I am buying for the people who gave me money. At the same time, I may be selling for the people who actually withdrew the money. So that's the difference. And what that results in is that in a mutual fund, a fund manager has to act on two things: acting to manage flows and acting to manage the portfolio. Whereas in a PMS, fund managers have to only act to manage the portfolio, but never in response to flows. I think that is something which is essentially a very, very big difference that one must keep in mind. What are the fallouts? What are the negatives of a PMS? I always tell people that the negative, if you go to a restaurant where there is an open kitchen, where the chefs are cooking behind the glass, they have to be very, very mindful of how they are going about their activities. So it's the same thing like, if you are managing equity, but with an open kitchen, that is how PMS complicates things. In another way, I also say what I've written here in the third point. PMS is like surgery without anesthesia. When you are everything that a PMS does, a mutual fund does the same things, right? But in a mutual fund, all the data is not that obvious and evident to you, and it's not fully transparent to you, so you think that it's not happening. Whereas in a PMS, every transaction, every commercial item, everything is disclosed. And I have seen one thing about transparency. A lot of people, if there is too much transparency, you need maturity to deal with it. Because a lot of times what I've seen is that if I don't see it, it's not happening. That's the kind of thought process that people have. But I think that PMS is so transparent, it needs maturity to actually handle it. While PMS is ideal for long-term discerning, a PMS is ideal for a long-term discerning investor who understands the value of owning their own segregated portfolio. I hope I have clarified it in the previous slide. They know that they will be able to add to a portfolio which is already known to them, curated, known in advance. So, if March 2020 comes, or if any big fall in the market comes, recently one of the days we saw mid-cap index 5% down. On such a day, if you were to actually invest, you would know in advance, because you go to your login section, you already know that if I give money, what is this guy most likely to buy? So you would know well, and you don't have to care whether they are getting inflows or outflows and net are they selling and what are they selling, etc. You know your portfolio. If you give me money today, you know exactly what all I'm going to end up buying. There is an unfettered investment mandate and there is pricing flexibility. So for example, one of the innovations we do is that we charge only if we make an alpha. So that is something which is unique to WhiteOak, and nobody in the industry actually does that. To have a performance-linked fee, and the performance-linked fee depends purely on outperformance over or alpha over S&P 500. Over BSE 500. So these are a few things where PMSs are superior. Last thing which I'm going to share, nowadays direct investing is taking fancy as well. This is my last slide. It makes few points on directly managed portfolio. So if you're a direct investor, why should you consider going for a professionally managed portfolio or a PMS? Now, irrespective of what people might make you believe, data is what really one should focus on. So what we've done on the left-hand side is we have taken a bunch of companies, and on the right-hand side, we have a second bunch of companies. What is common to both these groups of companies? Line by line, each of those companies, row by row, the companies have the same or similar market cap. But the companies on the left-hand side, you will appreciate, their share prices are low and these are perceived to be cheap. And the ones on the right-hand side, their share prices are high and these are the ones which are perceived to be expensive. If you see these two lists intuitively, you can also see that the ones on the right-hand side are the ones which have delivered all the returns in the last 5 years. And the ones on the left-hand side are all the ones which have done nothing in the last 5 years. Now, for the same market cap, what I would like you to focus on is how many number of shareholders does a company have? What was an eye-opener for me? For example, everybody seems to follow Mr. Rakesh Jhunjhunwala, and everybody seems to know that he made a fortune investing in Titan Industries. Not recently, but few days back or couple of years back, I checked how many shareholders does Titan Industries actually have. And I really don't know the latest number, pardon me for that. But when I checked it, they had 60,000 shareholders. Okay. Now, which companies, just see on the left-hand side, how many shareholders do companies on the left-hand side have? And the companies on the right-hand side, by the way, where did I get this list? These are all owned by us in our portfolios. So I just took what we own in our portfolios as an example. These are the companies which have delivered all the returns in the last 5 years. They are not perceived to be cheap. In fact, they are perceived to be very expensive. and see the number of shareholders. So while, if you see social media interactions, a lot of people might make you believe that they are expert stock pickers and everybody is performing very, very well. This data actually tells you the reality. The reality is, just see which companies have maximum number of shareholders, where is all the crowd, and where is the money actually being made. So that's just a very, very simple data for you to know why professional management through a mutual fund, through a PMS, whatever it may be, why it adds value into equity portfolios. So that's where I'll end what I, wanted to speak in scripted terms. I'll stop my presentation and hand back to Varun out here. Thanks for listening me out. Varun, over to you, and we can take questions.
Yeah, no, absolutely. Also, we've got a bunch of questions. We got 10, 12, but I maybe, I really liked, Aashish, 2, 3 things that you mentioned. I think one thing I really enjoyed was this list of investors. Yeah. So I'm saying, I think, a lot of us don't look at how many other fellow investors there are and how closely is the stock held, and what is the average value and what is the long-term holding. But that is very interesting data. The second thing I really enjoyed, which I thought was very unique, even learning for me and I hope for a lot of other people, is, let's say March 2020 happens, or a bull happens, or a bear run happens, or a black swan event happens. You have a right in PMS to choose as an HNI, as a mature investor, what you want to do, right? And maybe your call is, hey, I have more, this is my risk capital. Let's go ahead and, the prices are fantastic right now. Let's go ahead and buy. That could have been the approach. Somebody else could have said, hey, look, right now I don't want to take risk. I have a different opinion. You call up somebody like Aashish and say, hey, Aashish, I'm done. I want out, right? And I think that is the key difference. Really, if I was to look back, and a lot of people are going to ask questions, a bunch of us people have asked, why MF, etc., etc. But I think, Aashish, what I took away from your presentation were 3 points, and I'll just kind of repeat it for everybody. What I really liked is it's professionally managed, right? A lot of people think, and when PayTM Money decided to make India's, first PMS marketplace, like we're the first people on a mobile phone now, everybody scrolls and people see and they compare it like a mutual fund or like a stock. And when we did that together with PMS Bazaar, our goal was transparency. And I'm very happy somebody like Aashish coming here and saying, hey, I embrace that. And the regulator does it, by the way. SEBI is very, very, as strict and as serious. So I think that's a great message. Second message is people managing their own decisions, like a managed demat account, if you may, professionally. That's how I would term it. And the third is look at the stocks and how many investors there are. But Aashish, I'm going to jump into questions if you agree. Is that okay? So we jump in?
Please. Yeah, please.
Cool. So I'm going to take a question that we've got. I'm not taking names of consumers because, eventually these videos go elsewhere. But we got a question saying, hey, if I have 50 lakhs, okay, why should I invest in your PMS and not in your upcoming mutual fund? Both are as diversified, and MF is going to be more tax friendly with lower fees. And Aashish, a bunch of people have asked us the tax angle, saying, hey, in MF, you don't have to worry about taxes, deductions. Does the brokerage, does the fee they pay you, is it tax deductible if they have losses, etc., etc. So I think I think it would be good to get a detailed answer. मेरे पास 50 lakh रुपए है. Okay, and this is, I'm a mature investor. I think that's one big condition. But okay, I have 50 lakh rupees. Why should I not go into WhiteOak MF as compared to doing a PMS?
Yeah, so it's a fabulous feeling to have that the choice is between WhiteOak Mutual Fund and WhiteOak PMS. You feel great about it. But just on a more serious note, I hope I have done a fair job of at least explaining the structural differences. The difference between a pooled portfolio and the difference between segregated portfolios. So how the flow behavior of millions of people impacts, and how isolating flows is one of the keys to ensuring performance. The other thing which I also explained is that in a PMS, a fund manager reacts only to fundamental portfolio decisions. In a mutual fund, fund managers are forced to transact for also flow-related activities. So I hope that structural differences I have explained. I also explained that there is a difference purely that in a mutual fund, you cannot have performance-linked pricing, whereas in a PMS, you can have performance-linked pricing. And WhiteOak is actually the only PMS which has performance-linked pricing based on alpha, outperformance over BSE 500. So we don't charge performance pricing on some artificial hurdle like 6%, 8%, etc. We can offer that, but in reality, our standard pricing is to charge on So these are the structural differences. Now, so I hope that explains that, who should go for a PMS and who should go for a mutual fund. Apart from that, if you really ask me, I think there was also a question that, why do we have like 50, 60 stocks, etc. So, look, there's no right or wrong out here really. What I would say is that everything has to be logically, for a particular manager, what they are doing has to be logically coherent, correct? So let me explain this. If you see why does WhiteOak have, say, for example, 50 stocks? The reason is because we want to have a balanced portfolio. By balanced portfolio, I don't mean debt and equity. By balanced portfolio, I mean something else. If you are somebody who has a very high style bias, let's say some managers come and say, for example, there's one manager who's only quality. So bulk of his portfolio is FMCG, pharma, and a couple of financial services. There are some managers which are only small cap. There are some who are saying that I'm growth oriented or a contra manager, right? So most managers have a particular style bias, and it gets manifested in either the market cap that they own, or it gets manifested in their style, value, growth, defensive, cyclical, or it gets manifested in the sectors that they opt for.
Correct.
Right. So whenever you have a high style bias, it means that you are choosing to operate in certain segments of the market, and automatically you're eliminating a good part of the market, right? But these segments of the market which you're eliminating, eventually at some point in time, they will do well. That's why if you see, winners rotate.
Correct.
Like the guys who did very, very well in 2016, 17, 18 did badly because in 2018, oil went to 90 and ILFS defaulted. So three of your darling sectors are out. Oil marketing is out, auto is out, financial services out. Suddenly, from nowhere, in 2020, pharma became a darling, whereas it was a dog in the previous 5 years. Correct. So the point is that if you have any narrow mandate, if you have any style bias, if you have any preferences in terms of sector, market cap, or style, you will basically, what you're specializing in will result in massive outperformance if that part of the market does well. But it's in the nature of markets to rotate. So when the market rotates, style goes in and out of favor. Sector goes in and out of favor. Market cap goes in and out of favor. That's why winners rotate. So at WhiteOak, 5 years of existence, probably one of the only managers which has outperformed BSE 500 linearly year on year every year. Like every calendar year, it has outperformed BSE 500. There's no such manager actually, right? How does that happen? That happens because you have large number of stocks. So if you have large number of stocks, means you have killed all those biases. And the return is coming only from the stock selection. So it's not like we have no biases. Okay, there are a couple of biases we have. For example, we don't buy public sector enterprises. And we are perpetually 40-50% small and mid cap because we feel we can add alpha by operating in small and mid cap, right?
Yes.
The other point, which was that why is the turnover higher? So our turnover is not as low as some of the PMSs. It's not as high as a mutual fund. Our turnover is 30-40% annualized, and that is because we want to beat BSE 500 total return index on a consistent basis. So the idea is that if you're very, very valuation conscious, you will want to rebalance your portfolio and readjust the weights of the stocks.
Correct. No, very, very well answered, Aashish. And I'll maybe add a few things to what you're saying. For people who are trying to say, I have the wealth and I have the maturity and the risk appetite to do this, because I think those are three things that you have to process within your own self. But what I would do is we've tried to put all of the statistics, like somebody was asking me, another question had come saying, Varun, where can we see PMS versus mutual fund returns, right? I would tell you, hey, go to PayTM Money, click the PMS button. You have all the funds, all the PMS providers, beautifully organized, giving you returns, giving you details of the strategy, everything done. Right? And I think when you compare apples to apples, because of the reasons Aashish mentioned, you clearly see a performance difference, right? It's like very on your face. You'll not miss it, right? And you'll clearly see that some PMS providers, and like Aashish correctly put, WhiteOak has done a fantastic job there because there is a certain way of doing things and a certain consumer segment you're serving. You're not serving all retail Indians, at the same time, all HNI, at the same time, all risk averse. And I think that's where, you don't manage in a mutual fund in a large way. So when you compare a mutual fund versus a PMS, I think the question I would ask myself is, am I ready to, let's say, give out 50 lakhs to somebody who then can professionally do it without me investing that much of time and energy? And I think the transparency of returns, expenses is all available. It was not the case before. So I just wanted to add that, because I thought it was important. Then I think there's this thing saying, okay, the tax compliance becomes painful because you hold too many stocks. So I think
I'll explain that.
you talk about tax compliance and the tax part of the.
See, I think clearly in your previous question and this one also, in my experience, what I've seen is that two things. Clients always compare us for the returns we generate relative to our peers and relative to the BSE 500 total return index. So if I were to come back and say that, my performance is low because I didn't sell few stocks which I otherwise should have sold because I wanted to save tax, I don't think that gives us any reprieve, or that will ever give us any excuse for relatively lower performance. So first is that we are evaluated for highest performance over and above BSE 500 and over our peers. So maximizing alpha is at the prime focus, right? Second point is that my own assessment, and by the way, private bankers, wealth managers, third-party assessment has been done on our performance over the last few years. The difference is that, taxes might matter for a few basis points, like 0.4%, 0.3%, 0.5%, depending on the time that you really look at. So, in a product which has, let's say, last 5 years CAGR, which is high double digits, if by minimizing churn, I'm going to sacrifice performance, but end up saving only like 0.5% or something on tax, then I better focus on performance. The third thing is that bulk of that headache is taken on by our auditors, because at the end of the year, it is our responsibility to send a audited statement. Of course, if a person has a very, very large family office or a very, very large book, then they will need to put a professional who will not go by our statement.
But that's anyway
at the client PAN level, they will have to get it done. But so I'm not trying to justify what we are doing. I'm not trying to give excuse. I would just say that we will try to maximize alpha. Now, there's some question also, Varun, you mentioned about mutual fund versus PMS and the taxation.
Correct.
And let me tell you that over the years, progressively, the tax differential has gone down, not gone up. Because the reality is, and our churn is also, by the way, even at a PMS level, there are some PMS which have 10% churn, some have 20, we have more like 30-40% churn. But mutual funds have some crazy turnover, right? On a 100 crore volume, on a 100 crore AUM, they end up doing more than 100 crore of volume in a given year. Now, coming to the taxes, few years back, mutual funds didn't pay tax for within the mutual fund, any trades, they didn't pay tax. And on redemption, you also didn't pay tax because long-term gain was zero. Today, what has happened is that now that differential has come down, because mutual funds don't pay tax for trading inside the portfolio, but on redemption, you pay tax, right? So same way in a PMS, every stock which has a holding period more than 1 year, you are going to pay the same tax which a mutual fund also pay, but you will pay on redemption. Here you will pay if the PMS actually sells, right? So net, the tax differential has come down. It's not actually gone up. That is one. Second, for guys like us, like I said, 30-40% turnover means our average holding period for a stock is 2.5 to 3 years. And by the way, the whole mutual fund industry, average holding period for a mutual fund is also 2.5 to 3 years. So my sense is, what my experience tells me is that people evaluate us for relative performance or highest alpha. Tax is something which comes later. You first want the best possible outcome.
Absolutely. I'll take a headway to that question and go on to the other question. Somebody has asked saying, hey, I agree with participants. It's always interesting to know the alpha generated over similar MF. If it's not greater than 3% CAGR over 10 plus years, and Aashish, I'll answer that question. I would request that user, please go to PayTM Money, just go to the marketplace and see the returns by your risk appetite. And you will see that it is higher than 3% for a bunch of funds. And I think that's where the choice starts to kick in, right? Because I think that's very, very important, right? Then there's a question, which a bunch of participants are asking, which is around expense ratios, right? Saying, what is the understanding? How much do they actually pay? And what is the comparison? Like, how should a user compare MF expense ratio versus PMS expense ratio? Like, how should a user process that information? So let's say I'm having a crore and I do a equity fund or a flexi.
See, I think here there is a lot of confusion caused by transparency. First, let me clarify the myths. A lot of people think that when you are invested in a PMS, the PMS buys and sells stocks, right? Of course it does. And then, when that statement comes, they say, we are paying brokerage when a PMS is buying and selling stocks. We don't encounter this in a mutual fund. That's the problem of transparency. When a mutual fund buys and sells shares, they also incur brokerage.
Absolutely.
But you don't see it because it is capitalized in the cost of acquiring. It's not even reported in NAV, not reported anywhere. But if a mutual fund is buying and selling stocks, they are paying brokerage and STT. In a PMS, because it is transparent, you will be able to see that this brokerage and STT has been paid. So first of all, every expense, fund accounting, custody, banking transactions, every expense that a mutual fund incurs, every expense that a PMS incurs, all those expenses are incurred by a mutual fund also. The question is, you are seeing it or you are not seeing it. That's the first point. Second point, just like in a mutual fund, you would have 2 to 2.5% as your regular plan, and anywhere from 0.75 to 1% or 0.5 or whatever as your direct plan. The regulator has ensured that the same structures exist for a PMS also. In fact, in a PMS, the regulator has even facilitated that you can have performance linked fee, which is not possible in a mutual fund. So in a mutual fund, whether it outperforms or underperforms or whatever, the fee is what it is. Whereas in a PMS, so please, when I'm giving these differences, I'm only trying to educate. Like, I have no favorites really. I've been associated with the industry 22 years, and throughout my career, I've been managing money on PMS as well as mutual fund platforms. But we have to highlight the differences. I mean, the expense structures are pretty much comparable. In fact, a PMS has more flexibility.
Absolutely. And I think a lot of, when we started Ashish selling direct mutual funds on PayTM Money, I think we were the first in India to do so.
Of course.
A lot of people thought that, okay, direct mutual funds means coming on an app and clicking and buying it, right? Mm-hmm. And we tried to explain to them that, you pay your banker a distribution fee every year. So let's say you invested 10 lakh rupees. For the next 20 years, you're going to pay that banker who took a signature a distribution fee when you subscribe to a regular mutual fund. And a lot of people didn't believe us till they actually started seeing statements. And, the transparency is not there so clearly, but right. And I think as over the last 2-3 years, people exactly like that don't realize that they pay something called a total expense ratio. And a lot of total expense ratio when you compare to the returns generated. And I think that's the thing. Don't just look at expense ratios, look at expense ratios as a comparison of return. And I think that's what I would do. And for sure, the net difference has to make sense, right?
Sure.
Let me ask you a few questions which are, more operational. So somebody says, hey, can I subscribe to PMS as a corporate / a company, or must I go in as an individual? And then they say, hey, look, how come somebody says, hey, how does PMS take instructions from an investor? Like, how do you talk? What is your, okay, we like you.
So first is, strategy. Yeah. So first, as a company, you can invest as a company, as a private trust, as an individual, as a joint hold, which all those combinations are possible. Second is that a PMS doesn't, once a client opens a PMS account, it's the manager, the fund manager or portfolio manager's discretion to decide what to buy and what to sell. So PMS just, takes it's an agreement which has a limited power of attorney to act on behalf of the client. But for every trade or every transaction, it's not like a PMS first seeks permission or asks anything to the client. Of course, there is reporting of every transaction that is done, but that is post facto. But it's not, before the trade.
Yeah, sorry, I got disconnected again. I'm back. Yeah. So, yeah, and then Ashish, one user, and maybe I'm going to take this question as well. One user says, okay, how do we go about choosing the right PMS service provider? Okay, if I see PayTM's section, most of them show very high return. So this user has gone to PayTM PMS Bazaar section. He says, is that due to post-COVID boom or one can expect a decent return? So maybe I'll just talk a bit, Ashish, about how people should go about actually doing it. if they're curious, right? So first of all, I think my first suggestion to people would be spend time going through that section. There are a bunch of videos that we put together with PMS Bazaar. PMS Bazaar does a fantastic job of content. Go inside, have a look, come to PayTM Money, attend these seminars. Don't jump into doing anything. Then there's a place where you actually have to put your telephone number. So we then, somebody senior from my team who professionally manages all this picks up the phone, talks to you, right? And I think that's your step number 2. So step number 1, spend some time reading. Step number 2, we'll call you, right? And then what ends up happening is we set you up depending on your risk appetite, depending on whether we feel you're ready for it or not. Because a lot of users we've noticed, they don't want exposure like that, right? And so we say, okay, maybe not today. But if it starts to look good, we set you up with a PMS provider. You can talk to them. So maybe you'll talk to somebody in WhiteOak, and then the person in WhiteOak is going to be explaining the product to you in great detail. Go through it. These are all non-committal discussions, which means that आप सुन सकते हो, आप decide कर सकते हो आपको करना है नहीं करना है, right? It's completely your choice, and we'll do it one-to-one so that you feel a bit more comfortable. We understand it's 50 lakhs plus. We understand people who are serious, need private time. We'll do it at a time that's convenient for you. Once all that's done, there's a bunch of written documentation that actually comes to you. Please read it, right? And what we tell people is take your time to read it. There's no hurry, right? And once all that's done, we are with you, right? And then somebody asked me saying, hey, if I go to PMS, if I go to WhiteOak directly versus coming through PMS Bazaar, PayTM Money, is there a difference? No, there's no difference. Please, I think the idea of a marketplace is transparency. The idea that we are all here together with you is that. So, those are the tips I would give. But Aashish, help me a bit. We have a bunch of users, right? And this user asked me this question when saying, hey, Varun, I am 40. I have got 10 crores invested. I need now, I don't have time for doing this. Like, I don't want to manage. I want to live my life. I want wealth. How should I go about choosing the best PMS? So what would be the 4-5 things that you would look at, or 2-3 things? What would your checklist look like?
Sure. See, I would say, look, I'll answer this based on what I see as important, needless to say. And I'll answer this based on what I see as important is how my organization would be structured or constructed, right? So I would say 3-4 things. One is that, you will see what is the pedigree and the team, right? Say, for example, many times portfolio management services, they have one person, there is a key man risk, there is one person who's managing it, or, one person with 2-3 analysts. So for example, obviously, we are structured differently. Like Prashant, who's our founder, he founded WhiteOak 5 years back, but before that for 17 years, he was with Goldman Sachs, and he was CIO for their India equity as well as their global emerging markets. We have 25 people in the equity team, right? 3 are in dealing and execution, but 22 people in research. Say, for example, we are one of the largest foreign portfolio investors into India in the last few years, because we advise a lot of global money coming into India. So I would say institutional setup, size of team, that is something. Third is obviously track record. Fourth is, track record is just to get into the door, but is the track record backed by, because you're not concerned with past track record, you're concerned with sustainability of track record. So is it backed by a stock selection process or a philosophy? So 3-4 things, pedigree, team, track record, what resulted in the track record, is it backed by some process which would make it sustainable? So I think these are the things that one would look for.
Absolutely. And I will just add one more thing. Sure. I think more often than not, I have realized as I get into these things that comfort with the is so important at a personal level. I think because see, this is a journey that you will endeavor, right? A lot of people think I will put money in PMS in January, April I'm going to exit, and done. It's not that, right? You're getting into a journey with somebody far more professional into this 12 hours, 18 hours a day. And I think it's a journey. So finding comfort for me, as a fellow HNI, if you may, is very important for me, right? Like personally, my decisions are based first on comfort, and then I become hard-nosed about data, right? As compared to being hard-nosed about data and then finding comfort, right? So just think about that as you go along. Aashish, one question which everybody is getting, I think there are a bunch of people who've never done a PMS, okay, which is fantastic. I'm very happy for those people. They're saying, sir, please ek PMS samjha do. ये PMS है, this is the strategy.
Sure.
Completely.
Yeah, so frankly, that's a relatively simple thing, like because the WhiteOak offerings are very simple. We just manage one large bulge bracket kind of. By bulge bracket, I mean multi-cap, multi-sector, right? So it's I would say unfettered mandate. So it's just a portfolio. So the mandate of the portfolio is to invest across sectors and across market caps. It's a diversified portfolio. Like I mentioned before, the difference is more in terms of the structure, because instead of investing in a mutual fund, what you're doing here is that you are giving us a mandate to open a segregated demat account and on your behalf manage a portfolio for highest possible outperformance over BSE 500, which is the mandate that we agree to take. So, and our strategy is relatively, differentiated in the sense that we have our own valuation framework, which we call OpCo-FinCo framework. So we have our own unique proprietary valuation framework based on which we value companies. It's not based on typical PE multiples, price to book, dividend yields, or those kind of intra-sector comparisons. Second is we go for high governance companies. And the third is we look for scalable long-term opportunities. So these are the things that we really look for. And the most important, the fourth thing I will say, is that we believe in a balanced portfolio construction. Like, for example, when you ask me, why do you have so many stocks? That is precisely because we think that, a PMS portfolio is not just a list of stocks. When you assemble a list of stocks, there is an interplay. How, let's say, a rise in oil prices, how it will impact a bunch of stocks is very different from how it will impact another bunch of stocks. So while stock picking is important for fund management is not just about stock picking. I think portfolio construction also matters. When that whole bunch of stocks comes together, how it behaves when interest rates go up, how it behaves when currency changes, how it behaves when oil prices change, how it behaves when market is tailwinded versus headwinded. So high governance companies, scalable long-term opportunity, valuation consciousness, based on our own framework, and balanced portfolio construction. This is what we look for.
Absolutely. Our last few questions, Aashish, and then we'll try and wind up. One user has a very interesting question. I think is logged in from the States. He says, "Can American residents invest in PMS? And will audit report for tax purposes given for Jan to December calendar year, because American taxes are obviously Jan to December and not April to March." So I don't honestly know the answer to the question.
So we don't take, so WhiteOak being a regulated entity, we do not solicit PMS business in the US. The only thing that we do is, for example, some of our alternate investment funds, they are eligible to take money from US investors. And on the question, we do a local filing and we provide K1 statements to clients for the AIF that we do. So we have precedence of US investors investing in alternate funds, but not in PMS.
Yeah. I will also kind of answer this question slightly differently for the user. I think one of the good big changes coming into India is Gift City, and that's coming up as an offshore center. So a lot of, because of US residents, for example, because of FATCA, because of all the other rules and regulations governing American citizens, you'll notice a lot of PMS providers, fund managers, and brokers and platforms like us, staying away because the regulatory obligations / complexity of making sure a user is well taken care of is not so easy. And I think that's why, but in Gift City, a bunch of some of these providers, funds are going to come up, and maybe, it's I think early days, but maybe, sir, you'll find that there. And I think one, last question, Aashish, as we go forward, which I wanted to ask. There are a bunch of, questions that people have asked. I'm trying to, okay. So one interesting question. Can you do, this is a nice question, I'll ask it. Person has asked, and I appreciate the honesty. Are there any chances of fraud by PMS providers due to POA given by customer? Like, can a PMS provider do something really wrong?
Yeah, so, very, very good question. Very good question. Thanks for asking. A PMS, when it takes a power of attorney, that power of attorney is for operating a demat account, but That's not a normal Demat account opened with any broker. It's a Demat account opened with a custodian which is a third party. So for example, who is our custodian? ICICI Bank, right? For NR, we use HDFC Bank. For all resident Indians, we use ICICI Bank as our custodian. So if you give me a power of attorney by SEBI's PMS regulations, I will open your custody linked Demat account with ICICI Bank, and the power of attorney which you give to the PMS manager has to be approved and registered with the custodian. So it's not like because you gave me a power of attorney, it doesn't mean I can credit and debit stocks from your PMS account. No, you have given me a power of attorney which the custodian has to register at their end, and the custodian will only abide by instructions which fall within the remit of that specific power of attorney. So if I tell the custodian that debit Varun's account and credit Mr. XYZ ABC, the custodian is not going to process that instruction, right? So bank accounts are with a custodian, the Demat accounts are with a custodian, and the custodian is not somebody who will do my bidding. The custodian is regulated on his own under SEBI's custodian regulations. And by the way, it's, if it is a SEBI licensed PMS, see, a lot of people have been doing informal PMS in the past. They call, any informal arrangement, they call it PMS. No, a PMS is a specific regulation, with SEBI, and it has a form and format in which it functions.
Absolutely. And, Aashish, I'd like to add, I really enjoyed that question. Like I was about to do my last question, but I said, hey, look, that's a good question. And so, the person who asked this question, fantastic, because first, SEBI regulates all this, right? And I think that's why you see SEBI regulated PMS providers, and it's very tightly regulated, right? As much as PayTM Money, as much as a mutual fund house, as much as an exchange, so is Aashish and team. What that means is the basic checks and balances are done. The basic checks and balances are executed. Essentially, I think you need to be as less worried about PMS providers as you need to be about an AMC. I think that arbitrage is gone, right? And I would also ask you to be very careful, because we notice a lot of people trying to say, hey, I have understood stock market last 2 years. I exactly know how the market works. Let me manage your money. That is, by the way, not PMS. A lot of those exist. They are informal arrangements where you have these issues. Right. So my request to you, irrespective of the PMS provider you choose, please choose a regulated entity with a good provider, with solid backing, credentials, trust, and all of that. Right. Sometimes the returns look too good to be true, but that's why we said PMS is largely for mature investors. But hey, Aashish, I'm going to thank you. We got a bunch of questions, by the way. I know you may be wondering why I'm not taking them. They're not related to PMS. They're related to stocks, or they're related to people under 50 lakhs. I just wanted to end by saying, for those questions, PayTM Wealth Community has other sessions. Please join there. But this was a PMS specific session where we had a fantastic, a fantastic guest. And I, like I said, I was personally happy doing and hosting Aashish to our platform. I'd just like to end maybe by giving one last piece of advice to the HNI that is logged in here, who think, okay, I have the 50 lakhs capital. There's a very nice regulation that's come from SEBI very recently. It's called accredited investor. It's kind of in the works, okay? But if you get accredited, and we can help you do that as PayTM Money, what that does is it allows you to not do 50, but do a bit lesser, and so on and so forth, right? It's not the way you can think about it is, and that regulation is getting worked upon as we speak. So over the next couple of years, what's going to happen is that regulation is going to allow you much more benefit together with people like Aashish, who can then professionally help you manage your wealth, right, and protect it and create it. But yeah, thank you, Aashish, for coming. And I really enjoyed, and we'll get more questions from our users. Couple of them, we'll put them on to you in a separate one-to-one meeting, and so on and so forth.
Sure. Thank you. Thank you for having me.
No, thank you. Pleasure is all ours. Thank you. Nishark.
Yeah, thanks a lot, Varun and Aashish, for this amazing session. Thank you so much. Well, folks, that brings us to the end of this session. Make sure that you put your learning into action. It was great to have you on, and hope to see you in the upcoming sessions. Thank you and have a great day.
Thank you.